Hello guys, welcome to my channel. Welcome to Time Out with Yomi Martins. And on this channel, basically we give you information and education about how to make money, especially in forex trading, crypto trading, and every other thing that actually will put money in your Gucci bag. And if that's the kind of information you like, please stay tuned, smash the subscribe button, the like button, drop me a comment on what else you want me to touch on that will be, appreciated and useful to your trading life. Now, a lot of my subscribers have been asking me about the concept of order blocks. Right? Order blocks are actually used by institutional investors, the large banks and the organizations that really have big money, not retail traders. But retail traders have been taking order blocks, using it to their advantage because that is where the big money is actually waiting to buy or sell. Now, instead of reinventing the wheel, I actually sourced the video on YouTube, which I want to give some commentaries on, and I hope it will add some value to you. And when I make those comments, if you have questions, you can further ask me in the comment section, and I'll clarify what order blocks, or those questions on order blocks, or any other questions that you may have. So let's just dive into it right away.
Hey traders, and welcome to another episode of Smart Risk. Order blocks play a vital role in executing trading opportunities and are widely utilized by smart money traders. However, many traders struggle to identify valid and high-quality order blocks, putting their trades at risk. Trading without the ability to identify valid and high-quality order blocks can be extremely risky and may result in significant losses. In this advanced tutorial, we will delve into the intricacies of order blocks, exploring their various types, and providing detailed guidance on how to identify high-quality ones. We will uncover the rules and criteria necessary to spot high-probability order blocks on real price charts and demonstrate entry and exit models that leverage order blocks in the market. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. Let's get started with the major types of order blocks. The first type is the standard order block. In a bearish scenario, the standard order block refers to the zone corresponding to the last bullish candle before a sharp and substantial downward movement. The theory behind considering these zones as potential reversal areas is based on the belief that they represent manipulation areas formed just before a significant market movement. Traders view these zones as areas where a large number of buy or sell orders have been executed. Therefore, by using these zones in our trading...
Now, let me explain something to you very quickly. When you say a zone before, let me define it in another way. Another block will be the last candle, right, that you see before an impulsive move. Now, over here, this example over here, let me just show you very quickly, right? You can see this red candle, that's the bullish candle going up. And that was the last candle that you saw before the white candle, which is the bearish candle, appeared. That zone is the order block. Now, when you're drawing your order block, you start from the top of the wick, right? The very top of the wick and the base of the candle. So all this area here would account for your order block. Let's move right ahead.
Strategy. We can potentially take advantage of the high probability of price reversal and change in direction when it reaches these areas. In this example, we see that after the formation of the last bullish candle, the price experienced a sharp downward movement, leaving behind a significant inefficiency in the market. However, the price eventually retraced back up.
Now, when you're talking about inefficiency in the market, right? Right over here is where the inefficiency is. That space. The space between the base of the red candle and hold on a second, let me just show you, right? Inefficiency is measured in 3 candles, basically. Now, candle 1, candle 2, and candle 3. Candle 1 is the red candle that you can see here. The white candle is candle 2. Then this candle here, the next white candle is candle 3. Now, the candles normally overlap, right? They overlap. They are supposed to overlap one after the other. When you have a break between candle 1 and candle 3, it creates an inefficiency in the market as described here. The inefficiency in the market as described here is also called fair value gap, or FVG. So when you hear about fair value gap, they're actually talking about market inefficiency as well.
Filling the liquidity voids that were created during the downward move. As a result, the order block in question was mitigated, indicating that the market participants have successfully filled their buy orders. Subsequently, the price reversed once again and continued its downward movement.
Now, okay, let me just go back a little bit. Sorry about that. Okay. Let me go back a little bit.
The order block in question was mitigated, indicating that the market participants have successfully filled their buy orders.
Now, when you have an order block, you had an order block right over here. Price went down. It went down this way, and it came back up. This is what is meant by the price has been mitigated. The inefficiency in the market has been cleared up. The inefficiency on this side has been cleared up when price moved back up. And after it cleared the inefficiency and touched that other block, it went straight back down. So that's how order blocks behave, and that's how the market behaves. Once the orders have been met and the inefficiencies have been met, it goes back down to the direction it came from, or it can actually break it. In some cases, it can go far ahead and go to the buy side and continue traveling. But more often than not, it will touch the inefficiency and move back to the direction that it was meant to move back to.
Subsequently, the price reversed once again and continued its downward movement.
Continue the downward movement.
The second type of order block is known as the primary impulse order block. This type of order block occurs when the price fails to initiate a strong or significant movement after changing its primary direction. In the bearish scenario, the primary impulse order block is identified as the first weak bearish candle that forms just before a significant downward movement. It represents a point where the market exhibited a lack of momentum in continuing its previous bullish trend.
Okay, so you can see right over here, the red candle is actually bigger than the white candle, which is the sell candle, right? So when you're talking about the primary impulsive order block, right, the next candle that comes up right over here is not the momentum, or should I say the strength of that candle for that reversal was weaker than the previous candle, right? So at that point, that is where you draw your order block, because it does not really have as much momentum as it took off with on the buy side when it was coming back to the sell side.
Potentially indicating a reversal or a change in market sentiment. Let's take a look at an example. In this chart, we have a downtrend where the price created a bearish break of structure by breaking below the previous lower low, leaving an inefficiency behind. To identify the most recent order block generated by the price, we can focus on the first weak bearish candle that formed before the significant downward movement. This candle represents the primary impulse order block, indicating a potential reversal or change in the market direction. It is an area of interest where the price may reverse when it reaches that level, providing a high probability trading opportunity. The third type is WickBased order block. In the bearish scenario, a wick-based order block occurs when the shadow or wick of the last buying candle or the first week bullish candle is greater than half the size of the entire candle. In this pattern,
Yeah, basically, the wick, which is this line you can see right over there, this line here, right? It's this line here is greater than the body of the candle itself. So that's a wick-based order block. So what you pick is the zone of that wick and not the entire body of the wick. Let's go right ahead.
only the wick of the candle is considered as the order block, disregarding the candle's body. This manner provides an optimized and smaller zone compared to the considering the entire candle size as our area of interest. As you can see here, price sharply pushed to the downside and created a series of bearish BOSs. So it's clear that this candle located at the extreme is the first weak bearish candle formed before price created a sharp downside movement. But as you can see, the wick of the candle is greater than half of the whole candle. As we mentioned before, we should highlight the entire wick is our order block instead of the entire candle size. So, let's move into the next order block type, engulfed order block. In a bearish scenario, a bearish engulfed order block occurs when the last bullish candle's entire body is completely engulfed by the subsequent candle.
Yeah, unlike the previous example in which the subsequent candle that started off the changing trend was smaller, in the engulfing order block, the subsequent candle that starts off the changing trend, right, is actually bigger. That's the basic difference.
Indicating a strong influx of selling pressure that overwhelms the buying momentum, followed by a sudden and significant downward movement. In the given example, we see a shift in market dynamics as price breaks out of this structure to the downside, signaling a change of character from the previous uptrend. The candle we are focusing on is the last bullish candle formed before the bearish movement. Its entire body is engulfed by the following bearish candle, indicating a strong bearish momentum. Upon closer inspection, it becomes apparent that the wick of this bullish candle is greater than half the size of the entire candle. This raises the question, should we classify this pattern as a wick-based order block, focusing solely on the wick as our area of interest? Or should we consider it an engulfed order block, highlighting the entire candle? In this specific case, it is recommended to treat it as an engulfed order block, and consider the entire candle as the area of interest, rather than solely focusing on the wick. Let's see the next order block type, breaker block. Breaker block is a failed order block that has been broken through and turned into another supply or demand area on the chart. As you know, guys, market could ignore the order block supply and demand for many reasons, including a shift in market structure, being overvalued or being oversold, tapping into the higher time frame key levels, or resting key liquidity zones just below or above the order block. When a valid order block fails to reject the price, and price breaks through it, it becomes a supply or demand level, which we call it breaker block. Breaker block is usually most effective when price breaks through it with large momentum candles with a tiny pullback to it. Let's see an example. As you can see, price pushed to the upside and has broken out this order block with large momentum candles, and also left great inefficiency behind. In the following, we can see that price eventually pushed back down to fill the inefficiency, and also it's clear that price, after mitigation of the breaker block, sharply pushed to the upside. Also,
now, you can see inefficiency, just a minute. You can see inefficiency right over here in this zone, and you can see inefficiency right over here in this zone, right? Market came down, did a zigzag, covered the inefficiency created here, moved up, then pulled back down before it continued again in that same zone.
price ignored this standard order block, which was located at the extreme. So, let's move into the last order block type, mid-movement pivot order block. It refers to the formation of an opposite-colored candle within the midst of a strong bullish or bearish movement. This candle acts as a potential reversal signal. It signals the potential for a reversal or a temporary pause in the current market direction. The psychology behind that, we consider these zones as potential reversal.
Just a minute, I'm going to get that off quickly. It's the ad that comes with
areas
okay.
where price has a tendency to reverse and change direction upon reaching them. They serve as important signals, indicating a possible loss of momentum or a consolidation phase in the prevailing trend. Consequently, we monitor these zones in the market as potential reversal zones that require close attention. Traders, we have thoroughly covered the major order blocks that frequently appear on real price charts, enabling us to develop a solid understanding of how to identify them. Now, in the following section, we will explore the entry models that can be incorporated into our trading plans using order blocks. These entry models will serve as effective tools for executing trades based on the insights gained from order block analysis.
Before we talk about the entry strategies, I would like to say this very quickly. The higher time frame order blocks are stronger, right? If you are a scalper, you'll probably be looking at 4 hours, H4, 1 hour, 30 minutes, basically 4 hours, 1 hour order blocks. Then go back to the, the lower time frames to look at the inherent opportunities you can find there. But at the same time, while looking at the order blocks on the higher time frame of 4 hours, 1 hour, if you're a scalper, you can as well look at order blocks created during the lower time frames when you must have drawn the higher time frame order blocks first. So let's look at the entry strategies.
Diving into the entry setups, it's important to note a crucial step in your trading journey: backtesting your strategies. Before using a strategy or a setup in a real account, it's recommended to backtest it at least 100 times. Various factors like market conditions, trader psychology, sessions, risk management, and time frame influence a strategy's win rate. Backtesting helps traders gain insights and enhance their trading strategies. To help you with this critical step, we use the Trader Edge platform for backtesting our exclusive trading strategies and setups. If you're interested in using Trader Edge as your backtesting tool, be sure to check out the link in the description below. There are 4 primary types of entries that we can employ when executing trades using order blocks. The selection of a specific entry type depends on various market factors, such as the market's movement, sessions, volatility, and other relevant factors. By considering these factors, we can choose the most suitable entry type for executing trades effectively. The first entry method involves using the wicks to execute trades. In this type of entry, after identifying a valid order block, we place our buy or sell order directly on the wick. In the case of a sell position, we will place our stop loss a spread size above the higher wick of the order block. This entry setup provides a wider stop loss margin, which can directly impact the reward to risk ratio by reducing it.
Now, let me just quickly say this, because I had a question in our community today as regards where to place your stop loss. Basically, your stop loss will be placed ahead of the wick, right? If it's a sell trade, above the wick. Then you will now ask yourself how many pips. That's what the person asked me. It depends on what you're comfortable with, right? But when you're looking at risk to reward, it might be 1-to-1, 1-to-2, or whatever risk to reward you want to use. But as a rule of thumb, right, your stop loss, depending on what you are trading. If you are trading gold, it might be more volatile. If you're trading currency, the movement might not be that volatile, right? But as a rule of thumb, if you have a 10 pip stop loss, that can work for you above the wick of the order block and all that stuff. So that once you want to prevent price from eating it and your your stop loss being taken out so frequently, meanwhile, price will still go in your direction.
However, using this type of entry increases the probability of your order being triggered, since price may simply touch the wick and then push in your expected direction.
Yeah, that's why
The second entry type is referred to as the body entry. In this approach, once a valid order block is identified, the entry is placed based on the body of the candle. For sell positions, the stop loss is set to a spread size above the higher wick of the order block. This entry method typically offers a higher reward-to-risk ratio compared to the previous entry type because the stop loss is tighter. This approach carries a slightly higher level of risk. There is a possibility that price may only touch the wick of the order block and then move in the anticipated direction without triggering your buy or sell order. Consequently, that there is a chance of missing out on a potentially profitable trade opportunity. Let's move to the next entry type. The third type of entry, which I personally prefer and utilize more frequently in my trading plan, involves placing the entry at the midpoint of the order block zone once a valid order block is identified.
Perfect.
In the case of a bearish scenario, the stop loss is positioned a spread size above the highest point of the order block. This entry type offers a reward-to-risk ratio that is at least twice as large as the regular entry types mentioned. This is due to the refined entry point and the smaller size of the stop loss. This is precisely why this entry type holds a special place as my favorite approach. By employing this approach, we can potentially enhance the profitability of our trades while effectively managing.
It's actually the
Where's
best
your
strategy
paradise?
that I also
London,
use myself.
Doha,
I
Singapore,
would put
Miami,
the stop loss
Zanzibar,
at the middle of the order block.
Managing risk.
You understand?
The fourth entry type involves placing the entry based on the body of the candle once a valid order block is identified. In sell positions, the stop loss is set to touch the higher wick of the order block. This entry type is undoubtedly riskier because the stop loss is positioned within the order block zone. If the price intends to fully reverse the order block, it may trigger the stop loss. It's important to be aware of the increased risk associated with this entry type and carefully consider its suitability within your trading strategy. Let's delve into the rules and criteria for identifying high-quality order blocks in the market. There are 4 essential rules that we
Now, please listen very, very attentively to this section because it's not just about having order blocks. That's why I told you higher time frame order blocks are important. You can also pick lower time frame order blocks, no problem. But higher time frame order blocks, once you have drawn it in your charts, they are very, very important. Then apart from that, we are going to talk about some other rules like another block leading to a change of character or a break of structure, another block having inefficiencies, that's the fair value gap being present with the order block. Those are the things you also look out for and not just pick other blocks at random. Please listen attentively.
must follow in order to identify order blocks with a high probability of success. Rule number 1 states that a high-quality order block must leave a significant inefficiency behind.
Fair value gap.
Inefficiency refers to an imbalance between buyers and sellers in the market, resulting in a disequilibrium that needs to be filled. This is often observed as a gap within the candles. To clarify, let's consider 2 scenarios. If a 3-candle sequence does not exhibit any gaps, it is considered an example of efficiency. On the other hand, if there is a gap present within the candles, it signifies an example of inefficiency.
So basically, these 2 examples have order blocks. This one that does not have inefficiency, I will not basically draw it as another block. But this that has inefficiency right over here, from the candle 1 to candle 3, right, will be a perfect order block that I will work with.
Rule number 2 emphasizes that a high-quality order block must lead to a break of structure or a change of character in the market. Break of structure and change of character are essential signals that indicate whether the market will continue in its initial direction or will experience a reversal. Rule number 3, price must sweep a liquidity zone before reaching the order block. By requiring the price to sweep a liquidity zone before reaching the order block, traders can increase the reliability and validity of the order block as a potential turning point or area of interest. This rule ensures that there is sufficient market participation and confirmation of the order block's significance before considering it for trading decisions. Liquidity is a zone on the chart where a large pool of money is resting, such as stop losses and buy or sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. The market continually seeks to absorb this liquidity to generate momentum. Essentially, Liquidity serves as the lifeblood of the market, playing a vital role in its overall dynamics and functioning. It is often speculated that central banks or large financial institutions may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. It's crucial to understand that if price sweeps a liquidity zone before reaching our identified order blocks, then we can consider that order block as a zone with a higher probability of success.
Exactly.
The underlying theory is that the market relies on liquidity to sustain its movement. If the price fails to sweep liquidity before reaching an order block, there's a greater chance that the price will utilize that zone as a source of liquidity to propel its momentum. It's essential to consider this aspect when identifying potential entry points in the market, as it can significantly impact our trading decisions and outcomes. Here, in this example, we can see two bullish breaks of structures to the upside, leading to the formation of two distinct bullish order blocks. After a minor reaction from the upper order block, the price experienced a downward push to sweep the liquidity accumulated below the order block, and also the equal lows. The reason for price not reversing from the upper order block is the absence of a liquidity sweep pattern prior to reaching it. Consequently, the price utilized that zone as a source of liquidity, propelling its momentum. On the contrary, the reversal from the extreme order block can be attributed to the liquidity being swept below the upper order blocks and equal lows. By sweeping liquidity, the price gathered momentum and acquired the necessary fuel to move upwards. Upon reaching the order block, the price promptly reversed and made a significant upward move to sweep the buy-side liquidity. Thus, the extreme order block presented a higher probability of success in terms of trading opportunities. Rule number 4. It must be unmitigated.
Yes.
Order blocks are considered one-time use, meaning we focus on the trading opportunity when price first enters an order block.
Exactly.
Once an order block has been mitigated, we do not consider it as an area of interest for future trading.
At all.
Because once an order block has been mitigated, meaning that price has moved beyond its boundaries and the inefficiency has been resolved, it loses its significance as a trading area.
Exactly.
Subsequent retests of the order block may not yield the same trading opportunities as the initial entry.
Exactly.
That's it, traders.
Yeah.
In this episode,
basically, we have explained it. The video has been able to explain all the basic things, right? If the order block has been cleared before, that means it has been mitigated, right? Like right over here, this particular order block here that has been mitigated was touched right over here. But this one right here is unmitigated. That means it can still work for you because price can still move from over here back up to cover that other block zone and now clear it out. Now, I want this video to be very short. I hope you guys have enjoyed the content and everything. Please don't leave without subscribing. Subscribe to the channel, drop me a like so that other people will be able to see the video that, you know, is going to value, it's going to be important to them and everything. And drop me a comment as regards other videos that you might want me to do in terms of trading and all that stuff. Until I see you again, I remain your guy next door, Yomi Martins from the city of Lagos, Nigeria. As I always say, don't do what I won't do. Take care of yourself. Bye for now.